Welcome back to Skytech-Lens. The new North American trade war began not with cannons, but with tariffs. On June 4, 2025, President Trump doubled tariffs on imported steel and aluminum to 50%, citing national security. The White House argued this was essential to protect American industry and jobs, fulfilling a core America First promise. Supporters saw it as a bold move to revive U.S. manufacturing, but it immediately strained relations with allies, especially Canada. Canada, long a close partner, was stunned by the national security justification and the sudden economic blow. The tariffs disrupted decades of seamless cross-border trade, forcing businesses to confront a costly new reality. The stage was set for a high-stakes conflict that would test the resilience of North America's most important trading partnership. The impact on Canada was immediate and severe. The steel and aluminum sectors, supporting over 100,000 jobs, faced existential threats as access to the U.S. market was choked off. Mills and smelters in Ontario, Quebec, and British Columbia braced for layoffs and shutdowns. The auto industry, deeply integrated across the border, was hit hard as tariffs raised costs and threatened competitiveness. The shock rippled through supply chains, endangering jobs far beyond metals. For Canadians, the tariffs felt like a betrayal from their closest ally, justified on dubious national security grounds. Ottawa's political climate shifted overnight. Retaliation was now a necessity. The economic pain was real, but the political sting was just as potent. Canada's response would be swift and strategic. Canada struck back with tariffs on nearly $30 billion in U.S. goods, targeting politically sensitive industries. But Ottawa's response went further, a national plan to diversify trade and reduce reliance on the U.S. The government accelerated infrastructure projects, especially pipelines to Asia, aiming to reorient Canada's economy globally. Energy infrastructure, once stalled by politics, became a symbol of sovereignty and economic security. The crisis spurred investment in clean energy and partnerships with Indigenous communities, reframing resource development as both strategic and responsible. Canada's pivot was bold: retaliate, diversify, and build new alliances. The old model of North American integration was being replaced by a vision of independence and resilience. The government's message was clear: Canada would not be held hostage by U.S. policy. This was more than retaliation, it was transformation. The trade war became a catalyst for a new Canadian economic identity. The stakes had never been higher. Canada's greatest leverage in this dispute is oil. As the world's fourth largest producer, Canada supplies nearly 4 million barrels a day to the U.S., a lifeline for American refineries. Disrupting this flow, even partially, could cost the U.S. economy tens of billions and spike fuel prices. Ottawa began openly discussing new export routes to Asia and Europe, signaling to Washington that Canada had options. The message: U.S. energy security depends on Canadian cooperation. This oil leverage shifted the tone of negotiations and accelerated Canada's push for global market access. The goal wasn't to punish, but to ensure Canada's resources fetched the best price and weren't captive to a single buyer. Oil became a strategic asset in a high-stakes economic chess match. At the heart of Canada's new strategy is the Trans Mountain Pipeline expansion. Tripling capacity, it will allow nearly 900,000 barrels a day to reach the Pacific, opening direct access to Asian markets. For decades, Canadian oil was sold at a discount to the U.S. Now the pipeline promises higher prices and economic independence. The trade war turned this once controversial project into a national priority. The government framed it as essential for economic security and leverage in future negotiations. Even before completion, Asian demand for Canadian oil was rising, hinting at the project's transformative potential. The pipeline is more than infrastructure. It's Canada's pivot to Asia and a declaration of economic independence. In a world of shifting alliances, it's a bet on a new future. The trade war's human cost is real, felt by workers, businesses, and consumers on both sides. In Canada, over 100,000 steel and aluminum jobs were at risk. In the U.S., manufacturers faced soaring costs. American truck makers, reliant on Canadian metals, had to choose between absorbing costs or raising prices. Some U.S. firms looked to Mexico, threatening American jobs and investment. Consumers in both countries paid more for cars, appliances, and everyday goods as tariffs rippled through supply chains. The once seamless North American market fractured, exposing the myth of purely national products. Policies meant to protect jobs in one country often destroyed them in another. The trade war revealed how deeply intertwined the economies are. and how hard it is to build walls without self-inflicted wounds. Every action had unintended consequences. The lesson: in North America, economic isolation is an illusion. The dispute became a political chess match for leaders in Washington and Ottawa. For Trump, tariffs reinforced his America First brand and appealed to his base. Commerce Secretary Lutnick hinted at renegotiating USMCA, making clear the tariffs were part of a broader strategy. In Canada, Prime Minister Carney had to balance strength with pragmatism, retaliating but avoiding escalation. His stance was popular at home, but opposition parties and unions accused him of either overreaching or conceding too much. Every move was scrutinized for its domestic and international impact. Occasional diplomatic thaws, like a mid-August call, led to minor concessions, but core tariffs remained. The leaders were locked in a high-stakes standoff, each trying to force the other's hand. The future of North American trade hung in the balance. In late August, a fragile truce emerged after direct talks between Trump and Carney. Canada dropped some retaliatory tariffs and shelved a digital services tax, responding to U.S. exemptions and threats. But the most damaging tariffs, on steel, aluminum and autos, remained. The truce was a temporary ceasefire, not a resolution. Meanwhile, the U.S. escalated trade disputes elsewhere, signaling a broader, aggressive strategy. New U.S. rules on low-value imports hit Canadian online retailers, adding to the tension. Financial markets reflected the confusion. Canadian investors poured money into U.S. stocks, even as public sentiment hardened against American goods. The economic relationship was more complex than ever. Money flowed south, but trust was eroding. The truce held, but underlying tensions threatened to reignite the conflict at any moment. The future remained uncertain. As the dust settles, both countries face a new reality. Old assumptions about seamless trade are gone. The U.S. must weigh whether protectionism's short-term gains are worth long-term costs, higher prices, supply chain chaos, and alienated allies. Canada's challenge is to diversify without destroying the partnership that built its prosperity. The Trans Mountain Pipeline and new Asian trade links are now national imperatives. Both nations must decide: rebuild cooperation or keep building walls. The choices ahead will define North American trade, and offer a lesson to the world about the costs of confrontation versus the rewards of collaboration. The next chapter is unwritten, but the stakes have never been higher. Thanks for watching, and subscribe to the channel for more updates.